Okay, welcome back to the channel, guys. Hope you're doing well. So in today's video, we're talking all about inflation and interest rates, because I'm sure we're all aware by now that these have a very heavy impact on our investments. So the latest news of the hour is actually very positive. So wholesale prices rose 0.2% in October, less than expected, which was 0.4%. And when combined with the previous CPI reading for October, this indicates that inflation seems to be easing a little bit. It says right here that a significant contributor to the slowdown in wholesale inflation was the 0.1% decline in services, the first outright decline in that measure since November 2020. And on the back of this news, the S&P 500 is currently up 0.17%. The QQQ is up a little bit more, just over 2%. And the more conservative Dow Jones is up just 0.3%. And my portfolio is currently up 1.11%, somewhere in the middle. And this is how the different sections are performing. So growth is doing the best, followed by the S&P, and then my value assets. And I noticed from the comments on this channel that there's currently a big divide between investors. One group believes that inflation is just getting started, there's a ton more pain to come, and the other group is more optimistic, and they largely think that the worst of inflation is now behind us. Now, just so you guys know my bias, I'm definitely in that more optimistic group. Based off of what I have done in my research, it appears to me that inflation is now trending downward, and the Fed and their actions are actually kind of working. But I'm not the only one that thinks this way. Here is somebody way more qualified on CNBC on the topic.
Jeremy Siegel of the Wharton School. Professor, your reaction to this print on the CPI and the subsequent move in stocks?
Well, Scott, this is what we've been talking about, I think, for the last 3 months, that inflation is much lower than the Fed thinks. In fact, let me give you an interesting statistic, and follows up on what Josh was saying and what I have been saying for months, actually more than a year. If you put the actual home and rental price index in, not the one the Fed uses, which is very lagged, the actual one in today's index, you get negative core inflation. Negative core inflation. I mean, take a look at what core inflation on the shelter part was. Plus 0.8%. I mean, that's ridiculous. It's nowhere near that.
No way.
No way. I mean, that's the only, by the way, that's the only reason why core was positive. Not only is it zero, it's actually negative. And so if you put a negative number in, we're in negative inflation mode if the Fed uses the right statistics, not the faulty statistics that they've been using. So, you know, I mean, you're saying should they pivot? Yesterday.
So whether you agree or disagree, the data is very important. We all know that used cars, for example, is one of those inflationary things. In the past year, they skyrocketed in price. There was a little bit of a used car bubble. But if we look at the latest data, the prices of used cars is beginning to severely trend downward. This column shows the price action of used vehicles in the past 30 days, and every single category is negative, except for convertibles, apparently. And just more broadly speaking, we're all conscious that we are currently in a recession, or at least about to enter a recession. And through the lens of fighting inflation, this is actually a really good thing, and it's what the Fed is trying to accomplish. They want to see prices come down across the board. We're even beginning to see large technology companies introducing massive layoffs.
It's tech giant Amazon planning to cut 10,000 employees starting this week, according to the New York Times, and this is the largest layoff in the company's nearly 30-year history. It's also something we've now been hearing from so many tech companies, including Facebook parent company Meta, Lyft, and Twitter post Musk's takeover. What might be the spillover effect on the larger economy? Michael, we still have 3.7% unemployment. That is historically low, but as you see people lose their jobs in tech and they spend less money in the economy, that can happen and impact other areas as well.
So all of this data indicates that we are indeed entering an economic slowdown, which is how you fight inflation. And perhaps that's why inflation is beginning to trend downward. The Fed is actually doing their job. Now, the Fed, of course, did indicate that they will continue to raise interest rates in the future and keep them at an elevated level for some period of time. So the general consensus is interest rates will look something like this. They will continue to rise, ultimately peak, kind of plateau for a while until we have confirmation that inflation is indeed coming down, and then that'll be followed by interest rates also coming down. But the reason why we have green price action in the market when we have good inflation reads, it's not because investors think all of a sudden the Fed is going to slash their interest rates. That's very unrealistic. But rather, based off of the new economic data, investors are betting that the Fed will adjust the rate of their increases and be a bit more conservative. And if the terminal rate does come down a little bit, or the length of time rates are high decreases, then that value change will be reflected in the stock market. But let us know in the comments below what camp you're in when it comes to the state of inflation and interest rates. I'm definitely interested to know. But that's gonna do it for the video. Hope you guys enjoyed. If you did, like, subscribe, and I'll see you guys in the next one.